What if Nigeria's oil industry had just one giant lever to pull, and the government promises it will keep pulling it in Naira? That's the message today. The federal government has reaffirmed its commitment to sustaining the Naira-for-Crude deal with local refineries, a move hailed by many Nigerians as potential relief for fuel and energy costs across the country. Champion News. Here's a full breakdown of what's happening, why it matters, and what this could mean for Nigeria's energy future. What's the announcement? What's the deal? On October 7th, 2025, a federal minister confirmed that the government will continue using the Naira-for-Crude mechanism with domestic refineries, Champion News. Under this arrangement, NNPC, the state oil company, sells crude oil to local refineries and accepts payment in Naira instead of demanding foreign currency. This model helps shield refineries from foreign exchange volatility, lowers reliance on dollar imports, and, in theory, makes domestic fuel production more stable and affordable. The confirmation comes amid repeated uncertainties over crude allocations, foreign exchange pressures, and cost pass-through. Background: why the Naira-for-Crude idea was loved, questioned, and suspended. Early phase and promise. The Naira-for-Crude initiative was launched to address a key problem: local refineries buying crude in dollars, then selling refined products domestically in Naira, often under pressure to import fuel, further straining foreign reserves. By aligning crude supply and payment in the same currency, the government hoped to reduce forex demand and stabilize domestic energy markets. At one point, NNPC and Dangote Refinery signed a 2-year crude supply agreement under which crude allocations were paid in Naira. Around 82 million barrels were allocated between October 2024 and September 2025, with 60%, nearly 49.3 million barrels, sold via Naira-denominated contracts. Challenges and suspension. Dangote briefly suspended Naira sales in the domestic market, accusing that its Naira crude allocation had been exhausted. This suspension triggered concerns about whether the Naira-for-Crude model was sustainable. Many refineries, especially modular or small ones, complained the initiative did not include them, limiting access to crude under this favorable model. LCCI has called for extension to modular refineries. The Federal Executive Council, FEC, had earlier directed full implementation of the Naira-for-Crude deal to ensure energy policy consistency. Given all that, reconfirming it now is a message of continuity and confidence. Why sustaining it is relief? Potential benefits. A. Reduced exposure to forex risk. Refineries won't be as reliant on dollars, which are often volatile and scarce in Nigeria's market. Costs of imported inputs, logistics, and hedging pressures are mitigated when crude is priced in Naira. More stable crude supply. A direct crude supply contract in Naira incentivizes NNPC to prioritize allocations to domestic refineries, improving certainty of feedstock. Dangote's new 2-year crude deal under Naira terms reinforces that commitment. Reduced fuel import pressure. If local refineries can function more reliably and cost-effectively, Nigeria's dependence on refined fuel imports may decline, saving foreign exchange and cutting import bills. Downstream price moderation. Ideally, with more predictable input costs, refineries and marketers could pass on savings or at least minimize further price hikes to consumers. Signal to investors and stability. Consistency in energy policy strengthens investor confidence in the oil sector. It tells markets that Nigeria intends to lean on local production, not import dependency, in its energy strategy. The risks, doubts, and what could go wrong. Even a reaffirmation carries structural uncertainties. Risk or doubt. Why it's important. Forex backup costs. Some parts of refinery operations still depend on imported inputs priced in foreign currency. These costs may not vanish. Crude allocation shortfalls. If NNPC fails to meet crude allocations or prioritizes dollar sales, refineries may face disruption. Inclusion and fairness. Smaller refineries and modular operators might be excluded, retaining inequalities in access. Inflation and pricing rules. Even with Naira input, marketers may still inflate margins, passing costs to consumers. Policy reversal. Political or economic shifts could lead to suspension or rollback if pressure on the Naira intensifies. Operational inefficiencies. If refineries are poorly managed, they may fail to capitalize on the policy benefit. What to watch over coming months? Crude delivery reports, whether NNPC meets allocation targets under Naira contracts, refinery output and utilization rates, whether refineries operate steadily without intermittent shutdowns, fuel prices at the pump, whether the policy actually reflects in more stable or lower fuel prices, inclusion of modular refineries, whether smaller refineries gain access to Naira crude terms, regulatory adjustments and policy statements from Ministry of Petroleum, FEC, or sector regulators. Final thoughts. In a market where crude is priced in dollars and refined products sold in Naira, the tension between fuel supply, forex, and pricing has always haunted Nigeria's energy sector. By reaffirming the Naira-for-Crude deal, the government is telling refineries and the public, we intend to navigate that tension, not capitulate to it. But real relief for ordinary Nigerians depends not just on policy proclamations, but on crude flowing steadily, refineries operating efficiently, pricing discipline downstream, equitable access for all refineries, and policy consistency even under fiscal stress. If managed well, this reaffirmation could become a turning point in Nigeria's journey towards energy sovereignty. If mismanaged, it could be another dashed promise in a long chain of failures.
Thanks for watching. If you enjoyed this update and want to stay informed with fast, reliable news, don't forget to subscribe to Newsflash 360. Hit the notification bell so you never miss a story. Your next headline is just seconds away.